Okay, right. So guys, then let's start today's session. So today, guys, we will be focusing, like I said earlier, we will be guys focusing on what we can say consolidated statement of financial position. Now, guys, this area called consolidated SOFP will be tested both in your section section B, actually, my bad, section B, as well as MCQs. So like how we did, guys, last Monday, we will first start off with section B, the big questions, the 15 markers. Once we are comfortable with that part, maybe after the break, we can, guys, move on to MCQs of consolidation. Now, guys, from my end, there is a thing that I have to do, right? Last Monday, I promised to share some double entries and some short notes, but I was not able to. But today, right after the class finishes off, I will share those materials, both this week materials as well as the materials which I had used last week. Okay. Now, guys, remember, I will be going with a 5-step approach when it comes to consolidation, right? So, guys, remember, consolidation, it's important for students to understand the double entries. And also, guys, always have a standard way of doing things. That means better to have a set way. Like, we don't change our methods every single question. We stick to the same thing, right? Every question, we do it in the same way. Right. Now, guys, there's a question from the Kaplan exam kit, right? So a question called port and starboard. So it's a full question. So if I'm not wrong, by discussing this question, we will be able to touch on all sections of the SOFP. Normally, guys, when it comes to consolidated SOFP, there are a few things. We need to learn how to do the workings, group structure, net assets of subsidiary, retained earning group retained earnings, non-controlling interest, goodwill. So those are some of the common adjustments that we get in every single paper. Then, guys, on top of that one, there are other adjustments like fair value adjustment. Then on the other hand, current account transactions, unrealized profit related transactions, mid-year acquisition, and also on the other hand, we have share exchanges. So these are the transactions that we normally get in the exam regarding SOFP. So I think this question is going to help us to cover everything. So guys, when I'm explaining the adjustment, if you don't understand, you ask me, right? Because I will be explaining the double entry and everything. If you don't understand, stop and ask me, then I can help you out with your doubts. Right. Okay. Now, guys, first let's look at the requirement of this question. Right. Now, guys, see this question over here. First one, they're asking, select the formula that correctly calculates goodwill. So therefore, guys, what I have done on my worksheet here, I have prepared my goodwill working. And normally, guys, for the goodwill, there is a working as well as, guys, there is a formula. No? Okay. So I have got ready with that part over there, over here for goodwill. Okay. Right. Second one, it's a theory question. We'll come back to this one later. Okay. Then, guys, going down. Right. Over here, guys, this part. Okay. Now, guys, they are asking from you the values of PPE, inventory, trade receivable, other payable, and bank loan. So they are asking some values. Right. Now, guys, remember, for those who don't know about consolidation, see, guys, PPE, inventory, trade receivable are all assets. Trade and other payable and bank loan is liability. Normally, guys, in consolidation, how do we deal with assets and liabilities? We normally take the parent asset and with the subsidiary asset. We take the parent liability, add it with the subsidiary liability. This is what, guys, we normally do in assets and liabilities. So remember, guys, consolidated SOFP, if they ask you what is the value of an asset or a liability, what you should do? Simply take the parent one, add with the subsidiary one, simple as that. But yes, of course, there are going to be some adjustments to it, but the basic understanding is that parent assets and subsidiary assets are added, parent liability and subsidiary liabilities added. So that's the basic understanding, guys, that we have. Okay, then, guys, next one, task number 3. What amount should be included in the consolidated statement of financial position for non-controlling interest? Okay, so therefore, guys, now they are asking us the value of the non-controlling interest. So that one, guys, here I have done my working here, non-controlling interest working. And then, guys, final one, what amount should be included in the SOFP for retained earnings? Now they are asking retained earning working. So I have prepared this one also. Let's check and see, guys, on the next page. Are there any other questions what they have asked? No, that's pretty much it. The other two questions is, guys, one question comes from associate, one question comes from accounting ratios. Okay, so that's the requirement. So you saw, no, guys, so normally even in your exam, first of all, guys, run through the requirements and see what and what they're asking. Keep everything ready. Because, guys, understand, though it's a part 2, though it's a big question, your answer should be given in the MCQ form, no? So therefore, guys, remember, first read the requirements like how I did now and get ready with the requirement, like whatever that they need. Now you know. Then you do the question like how you are doing a part 2 paper, then you will be able to answer everything. Okay, now, guys, what we will do, let's start the question now from first. Okay. So normally, guys, when you do a consolidation, the first thing that you should decide is the group structure. So, guys, what is group structure? Who bought whom, what percentage, the date, all of that you have to consider. Okay, now, guys, let's look at this one then over here. Right, Roman number 1. Port acquired 80% of the ordinary shares of Starboard on 1st of January 2002. Okay, now, guys, look at the date carefully. Now, normally, guys, you can have two types of question. Mid-year subsidiary and a full-year subsidiary. So I'm planning to cover today both types of questions with you. Okay, so let's see, guys, over here what's happening. Now, see, our question is for 2006. Okay, our question, guys, we are doing, see, 31st of December 2006. Now, when I go to the requirement, it says Port acquired 80% of Starboard on January 2002. Can you see? 4 years ago, we bought the company. Guys, remember, if you buy the company at the start of the financial year, what does that mean? Now, this question is finishing in December 2006. No, guys, here see. If this question is finishing on December 2006, it starts on 1st January 2006. So if you buy the company on that date or way before that, then we consider the question to be a full year subsidiary. Okay, the question is finishing in December 2006. If you buy it on January 2006 or way before that, we consider it to be a full year subsidiary. Then there is no problem, nothing to worry about. It's easy. Right. So, guys, in our question, what happened? They bought it on January 2002, several years ago, which is a good thing. Right. So, guys, then let's start then updating the group structure. So, in my question, what happened? Port acquired 80% of Starboard. So, Port acquired 80% of Starboard. So, guys, remember, if we buy 80%, how much percent is left? 20% is left, right? Yeah. So, 20% is left. So, that 20%, guys, will become NCI. So that's the percentage of the company that we don't control. That's what we call, guys, NCI, no? Percentage of the company that we don't control yet. So over here, guys, there is a 10% NCI. And, guys, point to note, this is a full year subsidiary. Okay, this is a full year subsidiary. Done. Okay. All good now, guys. So therefore, we bought this person for 20%, sorry, for 80%. So 20% is left and it's a full year subsidiary. Done. Okay. Right now, let's see what they're telling. Port acquired 80% of the ordinary shares in Starboard for 300,000. For 300,000. Okay, now we have bought the company, guys, for 300,000. So when you buy the company for 300,000, that's what we call investment, if not consideration. In simple words, for how much did you buy the company? How much did you pay? That's what we call, guys, investment. So here we invested 300,000. So that should go to my goodwill working for how much we bought the company, 300,000. Right. On 1st of January 2002, at the acquisition date, the retained earnings of Starboard were 150,000. Okay, now guys, I'm going to teach you how to do working number 2. Now working number 1, that's it. Okay, because now you are not students who have studied theory with me. So therefore, guys, remember working number 1 is group structure. That is like this. You just have to understand who bought whom at what percentage. Now, how to do working number 2? Okay, now guys, listen carefully like this. Working number 2, now look at the name, net asset. What is meant by net asset, guys? Net assets means equity. That is the meaning of net assets. Okay. What is the meaning of net assets? Net assets means equity. Okay. Now, guys, look at this one, will you? How many equity components are there? 1, share capital, share premium, retained earnings. There are 3. Correct or wrong? So I will copy it to my working. Guys, listen. Doing all these in your exam is not compulsory. But you need to know how to do this. You understood? Without doing this, we can't get our answers. That's the biggest problem. So therefore, you need to know how these workings are done. So anyway, so the equity is this. So it has 3 examples. So guys, I'm going to now start writing it over here. Share capital, right? What's the other one, guys? We have share premium. And then, guys, what's the other one that we have? Retained earnings. These are the answers. Are you guys okay with that part? So how to do working number 2? Read carefully, guys. Net assets. What is net asset? Equity. How many are there? 3. Copy down the names. Right now, focus. There are 2 set of numbers. Net assets of whom, guys, are we focusing on? Net assets of subsidiary. Subsidiary means this one, guys, over here. Can you see? These are the answers that we are going to focus on in. Simple as that. Understood? Net assets means what? Equity. Equity of whom? Subsidiary. So guys, this is the parent. Normally, guys, you know that in the SOFP, first value is parent, second value is only subsidiary. If I'm to like just confirm you here, guys, port is the parent, starting. So therefore, those are the answers. Okay. Right. So now focus on this. Right. Now we have another problem. Where are we going to mark this? Guys, remember the numbers, what you get, those are the reporting date values. That means here, guys, see, reporting date means what? Reporting date means the day that we are doing the question. The day that we are doing the question, no, guys, these are the values. So therefore, the answers that you find on the SOFP are reporting date values. So let's mark that one over here quickly. 60,000, 10,000, and 250,000 rupees. Done. Okay. Now, guys, remember below this, you can have something called, actually, guys, there are 2 things, but it just depends on how you were taught in your class. Right. According to my teaching method, below this, there is one more thing that can come up called fair value adjustments. Right. These are the 3 things in the paper. Actually, below this, other 2 things can come. Fair value adjustment and unrealized profit. But the way that I teach consolidation, I don't mark URP inside this. Right? So I try to keep things simple for the students. So therefore, guys, remember, according to my teaching method, below these 3, for the foundation level or for the knowledge level, we have something called what, guys? Fair value adjustment. Right? Whatever that they give in the question, plus there is something called fair value adjustment. Right. So these are the 3 numbers that we have to take first. Are you guys okay with that part on how I took it? Right. Okay. Now, guys, remember this acquisition values are there, no? These values are always given in additional information. Got it? Reporting one, you can always find it here in your question paper. But okay, yeah. There is another one method of doing consolidation also, like how you said me, the working number 2, NCI share of net assets. But what you can say in the textbook, it goes as what you can say the NCI of the net assets of subsidiary. The method that you're doing is also 100% correct. There is nothing wrong with that. That's an alternative way. Here, what we are doing is in the textbook, how it's given net assets of subsidiary, that's how we are going to go. But don't change your methods in the final moment. If you're comfortable with that one, stick to that because that's the one that you have been practicing with. Okay. Final answers will be same, no difference, but the workings will be a little different. Okay. Right. Then guys, next part. So once you have done marking these values over here, now let's search for the acquisition values. Okay. Now guys, read this value. At the acquisition date, see this one. The retained earnings of Starboard were 150,000. So guys, see at the what date? Acquisition date, which one? Retained earnings. So guys, let me mark this one here, 150,000. Okay, now guys, let me tell you something. In the foundation level or in the knowledge level, or maybe actually guys, even in the next level in our paper called financial reporting, I have never seen share capital and share premium changing. Retained earnings, yes, always two different answers. But I have never seen share capital or share premium changing at the FA level or the FR level. It's always constant. Normally, guys, about the share capital and the share premium at the acquisition date, they usually don't talk about it. Meaning it's constant. So guys, you can always keep that in your mind, right? At the FA level and the FR level, the share capital and the share premium does not change. So copy the same thing, guys, over here, 60,000. Copy the same thing over here, 10,000. But guys, remember, to this, there is another one adjustment called what adjustment? Fair value adjustment also. We mark it inside this itself. There is another one to that. Okay. Okay, right. So guys, then that's all done. Right. Now, guys, let's move to the next part. Now, we can't close this yet. So guys, let me quickly recap this one more time. Working number 2, guys, how do we do once again? Net asset. Okay. So net assets means what, guys? Equity of whom subsidiary. So I went to the second column. I have 3 numbers. So I wrote the names. And these 3 numbers, okay, are at the December. December is the reporting date. So we copied everything. At the acquisition date, normally how do we find? Read the adjustment they will give. So I copied that. These 2 from where did I get? Those are constant. It does not change. So therefore, guys, we just copy the same thing. Normally share capital, share premium, guys, do not change. Okay, now guys, let's go to the next one. Right. Guys, can you remember I said after this, there is something called fair value adjustment. Now let me discuss with you how the fair value adjustments are done. Okay. Now guys, read this part. Right. And also guys, remember if you are having any doubts, like you didn't understand how this worked or you don't know from where I took the number, don't hesitate to ask, guys. If you ask only, I will be able to clarify your doubts. Okay. Right. Okay. Now guys, read this adjustment and see, guys, now what's happening over there. Roman number 2. Okay. Right now, guys, what happened here? At the date of acquisition, the fair value of all the net assets of Starboard, with exception to a plot of land, was recorded at cost, but it had a fair value of 180. Okay, now guys, it's like this. Now, usually, guys, when you go to buy a company, first of all, we need to value the company. Okay, now, consolidation means what, guys? We take over another company now. So normally, guys, when you take over a company, what happens? First of all, you have to value that company. Now, during this valuation time, sometimes we understand some assets are worth more. That's what we call fair value adjustment. And normally, guys, at the FA level, we don't have revaluation loss, no. So normally we have only fair value gain, increase. Okay. So during that valuation stage, we understand some assets are worth more in the market than what is being shown in the book. That's what we call a fair value adjustment. Now, guys, look at this one. Now, this subsidiary has a land where in the book it's being shown at 150. But the fair value or the market value is 180. That means, guys, how much has it gained value? It has gained value by 30,000 rupees. It has gained value. This is what we call, guys, fair value adjustment. Now, how do we mark this? Right now, guys, listen. Normally, guys, fair value adjustment, first you write it here. Fair value adjustment. Okay. Right. Now, guys, remember how much has it increased by 30,000? That 30,000 you should write it in the acquisition column. Why we are writing it in the acquisition column? Because it took place at that date here, at acquisition. So that time only it happened. That's why I'm writing it here. And this has to be reflected in our financial statement. Now see, this land is still owned. We still have the land. We have to show it in our financial statement today. Because it should be reflected on the financial statement, in the reporting column also, we have to mark it and show. This is only step number 1. When you do this, goodwill will become credit. Okay. Normally, guys, consolidation, I said you double entries. No? So when you do this, goodwill will become credit. Now, if you are thinking, how will the goodwill become credit? I'll show you. Okay. So guys, just remember when you do this part, step 1. What is step 1? Copy it in the acquisition date. Why it happened on this day. Copy it in the reporting column. Why? It has to be reflected on the financial statement. So you have to write it here also. When a student does this, what happens? Goodwill becomes credit. I'll show you how. So credit, right? Then where is the debit entry, guys, going to be? Right. Okay. You want me to explain the meaning of the fair value adjustment? Is that what you want me to do? Okay, I'll go through it one more time. No problem. Okay, right. So guys, over here, when you copy it this way, what will happen? What you can say, goodwill will become credit. Then guys, there has to be a debit. No, normally in accounting, debit and credit, right? So therefore, guys, when you do this, goodwill will become credit. And once the goodwill will become credit, there has to be a debit entry. Now guys, what are we revaluing, or what are we having a fair value adjustment for? We are having a fair value adjustment, guys, for what? Land. So therefore, guys, remember, land is a part of property. Can you guys remember in this question, they asked us to do PPE. So therefore, guys, like this. Okay. Right now, in this question, I hope you remember, there was a requirement that showed calculate the value of PPE. Now, guys, PPE is what? An asset. Normally, guys, assets, how do we deal in consolidation? Take the parent one, add the subsidiary one, and to this, you do the adjustment. Now, fair value, guys, has it lost value or gained value? Fair value has gained value. So, therefore, add another 30,000 to this. When you do this one, guys, what happens? Our land account becomes debit. So, when I copied it here, what happened? Goodwill became credit. How? I will show you. And our land account, when I added, our land account became debit. That's how you do the double entry. Let me, guys, go through it one more time. Okay, so what's fair value once again? Fair value once again, guys, it's like this. When you go to buy a company, or when you go to take over a company, first of all, guys, you need to decide the value of it. Okay, how do we decide the value of the company? What we do is, guys, we send people and we start valuing it. So when we value it, we sometimes realize the market value is higher of the asset. Now, in this example, this person called Starboard is there. No, guys, Starboard has a land which is 150,000 rupees. But on the market, it's going at 180. See, the value is more. That's what we call a fair value adjustment. So its land is 150, but the estimated market value is 180. That means 30,000 more we can include. That's what we call a fair value adjustment, where the non-current assets or the asset value is higher than that's shown on the market. That's what we call a fair value adjustment. So Normally, guys, at this level, it's non-current assets. When you go to the next level, there are some more things, but at this level, it's non-current assets. When the non-current asset value increases, when compared to the market value, guys, that's what we call fair value adjustment. So first you get the answer. 150 land went to 130, sorry, went to 180. So therefore, there is a 30,000 increment. Now the next part, how to mark this, right? Step 1, fair value adjustment, guys, you have to mark it in working number 2, both the columns. That's step 1. Why we are marking it in both the columns? It happened on this date here. At the date of acquisition, it happened on this date. Got it? Right. Then, guys, why are we showing on the reporting date? Because, guys, when we are preparing the statement, this land is still with us. Then we have to show this on our SOFP. That's why I'm showing it in the reporting column also. It happened on this date. It must be shown on the financial statement. That's why I have marked it over here. So when you do this, goodwill becomes credit. How? I will show you. Then credit, no. Then debit where? Land. Guys, land is a part of property. Property value is increasing. That's why we are adding. Guys, remember all these assets and liabilities. How do we solve? Parent answer plus the subsidiary answer, and then you will be able to, guys, get the final value. This is how, guys, I do my fair value adjustment. So first I get my answer. I write it in acquisition column and reporting column. It happened on this date. We have to show this on the financial statement. Goodwill becomes credit. And then add it to your PPE. Then PPE account will become debit. Right? Can you guys little bit check and see, are you okay with the fair value adjustments, guys? Anything that you didn't understand from that one? Don't hesitate, guys. Please ask, because fair value definitely will come. It will come in the next level, right? So therefore, make sure that you understand the concept properly. Right? Check and see, guys, any doubts that you have. Okay. Right. So, guys, any doubts, please ask. Don't hesitate. Okay. Now, guys, over here, the inventory part, guys, let me mark the answers for this one also. Right. Now, guys, remember, inventory is asset. No, normally, guys, how to deal with assets here, guys, look at this part. Normally, assets means how? Parent plus subsidiary. Yeah. So here, guys, 109,000 plus 80,000. Guys, trade receivable is asset. Assets normally, guys, how do we deal? Parent plus subsidiary. Trade payable is what, guys? Liability. Normally, guys, how do we deal with liabilities? Liability is normally parent, this one, plus the subsidiary. Right, last one, guys, 7% bank loan. Bank loan is also, guys, liability, no? So therefore, parent plus subsidiary, 300,000 plus 85,000. These are the answers, guys, what we get. Right. If we sell the land, then what happens? That 30,000 we shouldn't mark at the reporting date. Right? If they sell the land at the acquisition date, we still have to show the answer because it happened at that date. No. If we sell the land, then at the reporting date, that land is not there. So then we don't have to show that here. Okay. But normally, like that adjustment will come for FR. For FA, always the asset will still be with us. So therefore, you have to always mark it and show in both the columns at FA. FR, if they sell, then this will become minus. We don't have to show this at the reporting date. Okay. So like that, any other doubts that you have also, you can ask. No problem at all. Right. All right, guys. Now let me, guys, move to the next adjustment, guys, over here, which is Roman number 3. Okay. Right. Now, guys, look at this part, guys, over here. Right. Read. I will teach you how to do it. Okay. Just read. Okay, so guys, what happened there? During the year, port sold goods to starboard. Okay, so who is selling to whom, guys? Parent is selling to subsidiary. Makes sense? Okay. For 50,000, making a gross profit margin of 25%. 60% of these goods has been sold by starboard. Right, now guys, understand one small thing. When someone sells goods to another party by making a profit, and if they can't sell that to an outsider, now guys, see, port sold goods to starboard. One party sold goods to another party by making a profit. If the buying party can't sell this outside, see, 60% of the goods has been sold. That means 40% is still there. See, goods are not sold. When that happens, guys, that means your mind should quick. So what is this adjustment called, guys? Unrealized profit adjustment. Are you clear with that part? Once again, guys. Okay. When one party sells goods to another party by keeping a profit. My case, port is one party, sold goods to starboard is another party by keeping a 25% profit. And the buying person can't sell it, person has been sold. So if it's adjustment, unrealized profit adjustment. So like that, you should quickly learn. Right, this is this adjustment. Got it, guys? So it's the unrealized profit adjustment, guys, over there. Yes, last week also I didn't do that actually. I'm so sorry. Today, definitely after the class, I will share my working. And also, guys, this is the double entry part, guys, that I was telling. Here, guys, I'll just show you over here. Here, guys, see? Right, this part. Parent, who is subsidiary, how to do the 5 workings. Okay. And also, guys, one more important thing that a student should learn is this part, guys. Now, I'm giving you all a short note here, guys, this one. Types of adjustment. Like if fair value adjustment come, what to do? Here, guys, see for an example, this part here, fair value adjustment, what to do? And yes, consolidation, you should learn it in both ways. What to do, like what to add and what to subtract, or maybe what and what to go and add. And on the other hand, guys, you should also learn the double entry. So what I have done is in one page, I have summarized the lesson. This is the adjustment. This is what you should do. Here, guys, see, record in both acquisition and reporting column, like how I did. Also the PPE. See, I'm explaining you what to do. On top of that one, guys, I'm also giving you the double entry. When you do this, this is the double entry. So like this, guys, I have summarized the entire lesson in one page. Definitely, guys, after the class, I'll share this with you. So you have a full summary on the consolidated SOFP lesson. Like that next week, when we do income statement, I'll give a short note on that also. So this one, guys, very easy. This is the adjustment. This is what to do, and these are double entry. Everything, guys, I have provided for you. I'll definitely share it after the class. So sorry that I was not able to do it last week. Right. Anyway, guys, coming back to now the exam question over here. Right. So over here, guys, we call this as an unrealized profit adjustment. Right. Okay. So now we understood, okay, this is an unrealized profit adjustment. Right. Right. Now let's go forward. At the reporting date, so guys, unrealized profit, we have to calculate. I'll teach you how to do that. So leave that aside. At the reporting date, starboard still has a payable for port. Guys, this adjustment, yes, I will definitely share the last week one also. Last week, the cash flow working, my worksheet, as well as questions. I will share both last week and this week. Both the works, I'll share it with you. Okay. Right. Okay. Anyway, guys. So over here, guys, now can you see starboard has a payable to port. Right. Now, guys, this is what we call a current account transaction. Got it, guys? So remember once again, what is this one? When one party has to pay another party. That means we consider it as one party is a trade receivable, other party is a trade payable. This is what we call a current account transaction. Guys, remember in consolidation, current account transactions are eliminated. Is that clear, guys? See, guys, once again, starboard has a payable. That means starboard has to pay. That means for starboard, this will become a trade payable. For port, he should get money. It will become a trade receivable. So for those who don't know this part, guys, normally when one company is a trade payable and the other company is a trade receivable, we call these as current account transactions. What do we do with current account transactions? We eliminate. That means, guys, now see, for one company, these are trade receivable. No, go to trade receivables, eliminate. So when you do this, trade receivable will become credit. For the other party, this is trade payable. No, so go and remove that from them. So remove 30,000 from them, then trade payable will become debit. Right. Once again, guys, I'll teach you. When one company has to pay money to another company because of a sale. Now, because they sold, now it became a receivable and a payable. Such transactions are called current account transaction. How to adjust it? Subtract. Go to one company, trade receivable minus, then trade receivable credit. Go to another one company, remove that from trade payable, then trade payable, guys, will become debit. This is how current account transactions are done. Go to trade receivable minus, go to trade payable minus, simple as that, right? Right. Okay, now guys, let me teach you how to do this thing called, guys, URP. So guys, what's URP once again? That's where one party sells to another party by keeping a profit. And if the other party can't sell it successfully to the outsider, that's what we call URP, which is unrealized profit. Right now, guys, remember, when it comes to URP, first learn how to calculate it. Right now, guys, this is the equation that I normally use to calculate my URP. Okay. Now, normally, guys, there can be two situations. Parent selling to subsidiary, that's this. Or subsidiary selling to parent. Don't worry, I will cover both situations for you today. Parent selling to subsidiary and subsidiary selling to parent. So regardless, first you sit and calculate the URP. So guys, how to calculate URP? Profit into inventory held. Now guys, look at this one. 60% has been sold. Now we are not worried about what we sold. We are worried about what is left. See, inventory held means what is left. So guys, how much percentage is left? 60% has been sold means 40% is left. So therefore, guys, over here, inventory, 40% is left, it seems. Okay, right. And then, guys, over here, they are telling this is a 60. Okay. By making a gross profit margin of 25% on sales. That means, guys, on the selling price, these people are seeing 25%. So now, guys, we have to calculate the profit. So how to calculate the profit, guys? Look at this one. Selling price is 50,000 rupees. See, port sold for. So that's selling price. So now, guys, I need the profit. So, guys, remember, this is what? This is a margin. So, guys, remember, if it's margin, profit is 25%. Sales is always 100%. Therefore, the cost will become 75%. That one, guys, you know, no? Right? Markup margin. Again, if you don't know, guys, markup margin, listen. Now, guys, this is margin. No? If it's margin, selling price is always 100%. Sales is always 100%. If it is markup, cost is always 100%. So don't worry, I'll teach you that in another question. Now we'll focus on this one. So guys, over here, what's happening? It's a profit margin. So profit is 25%. So if it's a margin, selling price is always 100%. And the cost is the remaining 100 minus 25, 75. Right. Now, guys, what do I want now? Profit. How to calculate profit, guys? Now see, selling price is 50,000 rupees. No. This is for 100%, no, divide by 100. Now, guys, we want profit, no, profit is how much percent? Profit is 25%. So, guys, multiply this by 25, right? Check and see, guys, then your answer will be how much then? 50,000 divided by 100. that multiplied by 25. So therefore, guys, answer for profit is 12,500 rupees. 12,500 rupees, you put it here, multiply this by 40%. This is your URP. So guys, URP will become 5,000. Right? Can you guys little bit check and see, are you okay with the calculation, what I did? Anything that you didn't understand, please ask me, guys. So guys, listen, though I made it look complicated, what I simply, guys, did was this. Now, this is, guys, margin on sale. No, that means you have to calculate 25% of this. That's the profit. That's the meaning of the sentence. Okay. See, guys, gross profit is 25% of the sale. That means we are keeping a 25% profit on our selling price. So from the selling price 50,000, I saw 25%. That's my profit. But I am not looking for profit. No, guys, I am looking for what? Unrealized. So that's why I am multiplying it by 40%. How did we get 40%? Starboard sold 60%. So when someone sells 60%, they are left with 40%. So that's how, guys, we got the answer, 5,000. This is how we calculate URP. So these are, guys, two things. First, you should learn how to calculate. Then I can teach you the double entry. Right, check and see, guys, with the calculation part, whether all good. Any doubts that you all have on the URP calculation? Okay, right. Okay, now, guys, let's learn the double entry. Okay, now, guys, remember, if parent sell to subsidiary, what's the double entry? Inventory will become credit. Inventory becomes credit means what, guys? Minus. And if parents sell to subsidiary, think carefully. Parent no makes the profit. Does that make sense? If parent sell to subsidiary, who makes the profit, guys? Parent. Where does parent keep his profits? Parent is keeping profits inside, but is retained earnings. So therefore, retain the double entry or the adjustment if the parent sells to subsidiary. Okay, now, guys, we are selling inventory. No, so what's our objective? Remove the profit, right? Understand, guys, from the URP adjustment, what's our end goal? We want to remove the profit. So because you want to remove the profit, what are you selling? Inventory. So from inventory, remove that. That's why inventory becomes credit. Right. Then next question. Who is making the profit? Parent. Because parent is the one who sold. So he gets the profit. So if parent is making profit, parent keeps his profit inside retained earnings. That's why from retained earning, we remove the other one. So retained earning will become debit. This is how, guys, the double entry is done if the parent is selling. Now, you might be having a question. But if the subsidiary sells, don't worry, I will teach you that also, guys, in a different question. For this question, just learn when parent sell to subsidiary, inventory credit. Who makes the profit? Parent. So retained earnings will become debit. That means, guys, now see inventory credit. No, so go to inventory and minus this. Minus 5,000 rupees. Done. And retained earnings debit. Retained earning debit means, guys, go to our previous working. Here, guys, can you see? Retained earning. I'm opening a working now, guys, here. So go to that working, write URP and mark there minus 5,000 rupees. This is how, guys, the URP adjustment is done if the parent is selling to the subsidiary. If the subsidiary is selling to the parent, it's little different, slight different. I can teach you that also a little bit later after we finish this question. So this is how, guys, the URP adjustment is done if parent is selling to subsidiary. Okay, right. Can you guys little bit check and see, guys, are you comfortable with this URP adjustment, what I have done just now? Any doubts that you want me to clarify? Please tell me, guys. Okay, no, guys. So seems like there is no doubts. Okay, so I think I have done all the adjustments of this paper. Yep, we have done. Okay, guys, now let's go line by line and see whether have we taken everything into consideration. Okay, right. Okay, now guys, look at this part. PPE taken, investment here we took no guys over here, so no need to worry. Inventory, trade receivable, cash. Guys, in our paper, they didn't ask about cash, so we don't have to worry. Right. Share capital of parent. Okay, normally, guys, remember share capital of the parent is not taken to these workings what we have. Normally, guys, share capital of parent, share premium of parent goes to the SOFP directly. We don't copy it into any of these workings what you see here on the screen. Okay, right. Retained earning of port. This we have to take. Okay, 1 minute, guys. Is a question being asked from me? Wait. No. What we should do is you have to take profits 40%. Yeah. That 5,000 answer. Okay, wait. Okay, wait. That student who had asked me a question, I'm now sending another one question to you. Can little bit answer this? Then I'll be able to clarify your doubt. Okay. One small doubt, I'll quickly clarify it with the student and then we'll continue. Okay, because I think there's a doubt there. Yeah. Okay. Right. Okay. Okay. Then can you also tell me the 20%, where will you mark that? Then I can try your doubt. Now you said me 80%. Okay. I understand that one. How about the balance 20%? What do you do with that one? Because the thing is, there are different methods of doing consolidation. That's why I'm asking you that question because I don't want to confuse you. The balance 20%, what do you do with that? Are you going to, I mean, in the method that you were taught, do you take that to the NCI working? Okay, right. Anyway, I'll just clarify the doubt. The reason why I'm taking the complete 5,000, the why I'm not putting, right. Okay. Right. No issue at all. No. The reason is this. There are two ways of teaching consolidation, right? So I think some of the students in this class have learned a different method. I'm teaching a different method. That's why I asked that question because I don't want to confuse you with my method, right? Okay. Right. It's like this. Now, for 5,000, I didn't separately put 80% because, okay, but a doubt is very, it's a good doubt, okay? The good that you asked from me so that you're not going to get confused. Okay. The reason why I didn't put separately 80% is because thing is this. Now, who makes the profit in this case? You have learned 3 methods. No. Okay. Right. Okay. Now the reason why, okay. Anyway, now just answer this question to yourself. Who made this sale? Parent. Got it? Super. Now parent is the one who is making the profit. No. Right. Now think and see that student who had sent me that doubt. Does the parent has to share this profit with anyone? Think of it that way and see. Parent sold to subsidiary. Parent had made a URP of 5,000. So parent made a profit of 12,500. So from that URP is 5,000. Right. My question is, does the parent have to split his profits among anyone, or can he take his profits all to himself? What do you think that should happen? When a parent is making the profit, does he have to share it with anyone, or does he keep it all to himself? Exactly. Because he keeps the profit all to himself, we don't need to put any percentages. The percentages must be put in a situation where the subsidiary is selling to parent. Because when the subsidiary is selling to the parent, subsidiary has to share his profits between parent and NCI. That time only we will be putting the percentages as 80% and 20%. If parent sells, parent makes the profit. His profit, he doesn't have to split it anyone. 80%, 20%, like that, he doesn't have to split. That's why this entire thing, I took it to myself. But if it's the other way around, let's say for an example, if Starboard had sold to Port, subsidiary is selling to parent, then we have to put 80% and 20% separately, because it's the subsidiary who is making the profit. Because parent is making the profit, he keeps all to himself. He doesn't have to share it with anyone. That's the reason why I'm not putting the percentages. Now, are you okay with that part? Super, right? So like that, guys, any doubts that you have, please send it. Then with logic, I can explain it to you how things work. Okay, so guys, anyway, coming back to the question, right? Now, guys, over here, what happened? Yeah, I stopped at here. Share capital and share premium, guys, please remember, we don't mark it inside the workings. It goes directly to our SOFP, right? Retained earnings. Now, guys, see, Port is the parent now. For the retained earning, we are doing a working. So therefore, I have to take this one, guys, over here as my opening balance, 295,000. Okay. Guys, now these answers we already took. I hope you remember 60, 10, and 250. I have already taken it to where? This one, guys, over here, which is my reporting column. 80 and 20 normally, guys, goes to the SOFP directly. It doesn't go to any workings. And this 295, because I'm doing a retained earning working, I have taken it here as the brought forward of the parent. Non-current liability, trade payable, guys. Now everything is done. Now we just have to, guys, finish our question. Okay. Now, guys, let me teach you now how to complete working number 2. First of all, guys, total it up downwards. 150 plus 60 is 210. 210, 220, 250. Right. That means, guys, over here, the answer will be 350,000 rupees. Let me check that, guys, one more time. 250, 310, 330, 320, and 350. Correct. Okay. Now, guys, what you do, go this way, compare. 60 to 60, there is no difference. 10 to 10, there is no difference. 150 to 200, there is a difference of 100,000. 30 to 30, there is a difference of 0. 250 to 350, guys, there is a difference of how much? 100,000. Done. Okay. Now, guys, what we need to do? Okay. Now, guys, learn this part. This difference is what we call post-acquisition reserve, in short form, PAR. Okay. Guys, this answer, we call it as PAR, which is post-acquisition reserve. Okay, I'll finish this off, right? Post-acquisition reserve. Now, guys, remember this answer needs to be split between parent and NCI. Okay, because bottom line is, guys, from the day that you bought to the day that you're preparing the question, our retained earnings have gone up. So when the retained earning goes up, what does it mean? We have made a profit. So normally, guys, when subsidiary makes a profit, he has to give it to the owners. Think of it that way. Now, guys, over here, what increase? Retained earning. Normally, why does the retained earning increase? Because what? They make a profit. Now, normally, guys, when a company makes profit, who takes these profits? Owners. Now, guys, who owns a subsidiary? 80% is owned by the parent and 20% is owned by the NCI. So therefore, guys, what you need to do, this answer, you split 80% inside parent, 20% inside NCI. So therefore, guys, now we are doing an NCI working. No, so you go to your NCI working. There you have post-acquisition reserve. Now you show the answer 100,000 into 20%. Now, guys, listen. Normally, I have noticed students are comfortable with the NCI part. Now, when I tell you to take 100,000, 20% inside NCI, definitely you will go and write this inside NCI. That I know. But when I ask you to go and mark it inside the parent, you get stuck. That's because there isn't a working called parent working. Now, NCI, it makes sense. We are writing it inside NCI. I say to go and guys, no guys, you from where therefore guys, the working here it inside this 100,000 into a guys will you do the post acquisition reserve working. So guys, once again, total this right. Okay, sorry about that. I got disconnected. Okay. Anyway, guys, like I was explaining to you all. Yeah. So I was explaining, yeah, this one, guys, this 100,000. Split it always between the parent and the NCI, not 100,000. Whenever there is a difference, split it between parent and NCI. NCI answer, you always, guys, go and mark it inside the NCI. Okay. Parent answer, if you ever forget, just ask yourself who caused the difference. Now, guys, this 100,000, who caused the difference, guys, over there? This 100,000 difference was caused by retained earnings. So therefore, guys, you give it to your retained earning. This is how we work out what you can say, guys, our retained earnings, or maybe our working number 2. Okay, now guys, once done, now let's move it. Okay. Right, now guys, when we move to goodwill, it starts off with investment that we already marked. Value of NCI. I think I didn't come across this part, or maybe I think I skipped that one, guys. Here I have skipped it. The fair value of the non-controlling interest is $80,000. Can you guys see here? Fair value of NCI is 80,000. Right, now guys, normally how do we mark fair value of NCI? Like this. Step number 1, copy it here. Value of NCI, 80,000 rupees. Copy it, guys, where? In the goodwill working. Copy it here first. So, guys, when you write it here, what happens? Goodwill becomes debit. Is that clear? When you get the fair value of NCI, first, guys, you write it here. Value of debit, because goodwill is an asset, no? So, when you put positive for an asset is debited. Then where is it credit? Here. There is an NCI working. No, in the NCI working, you go and copy it here. Then NCI will become credit. That's what, guys, you have to do. Copy it to goodwill. Goodwill will become debit. Guys, don't worry. That short note what I showed you has all these guidelines. What to do, what's the double entry, everything. So anyway, guys, copy it here. Then goodwill becomes debit. And then copy it to NCI. Therefore, the NCI, guys, will become credit. Copy it here, goodwill debit, copy it to NCI, NCI credit. Okay. Now, guys, next line. Minus net assets at acquisition, working number 2. Okay. Now, guys, read this carefully and see, guys, one more time what's happening. Net asset at acquisition, working number 2. This is working number 2. This is the acquisition. What's the answer? 250,000. Mark it over here. Done. Right now, guys, calculate your goodwill. 300 plus 80, 380. 380 minus 250. Yeah. In some papers, they give the value of NCI. In some papers, they don't. If they don't give the value of NCI, I'll show you how to calculate that one. I think there are some MCQs. I'll teach you how to calculate the value of NCI if they don't give. Most of the time, they give. By any chance, and they don't give, there is an equation. I'll give you that one. Right. Okay. So, guys, 300 plus 80 is 380. 380 plus minus 250, 130,000, guys, will be the answer. No, wait. Not one. Yeah, no, 130,000, guys, will be the answer. Okay, then, guys, this one just totally tap. 295 minus 5 will be 290 plus 80, 370,000. This one, guys, 100,000. Okay, right. So, guys, just spare me a few seconds. I'll quickly connect this to the charge. Okay. So, guys, then with that one, that part is done. And then, guys, what we should do after that one is simply to close our working, guys, over here. So, guys, this one is not difficult, no, guys, this part of the question. Just, add these two, subtract. Like that, you just have to now, guys, update these values, then you will be able to get your answer. So, guys, now let me just show you the requirements one more time. So you will have like a thorough understanding of what to do in your exam. Here, guys, see, look at this part. Right, first one, they are asking, task number 1, state the formula which correctly calculates goodwill. Now we calculated, I think, guys, I'm having a unstable connection. Okay, we'll see. Anyway. Okay, now, guys, look at this part, will you? So what they are telling, state the formula that helps you to calculate goodwill. Look at this part, will you? Right, see, right. Okay, now, guys, how did we get the goodwill? We got 300 plus 80 to 50, no? That's how we got the goodwill. 380 minus 250. 300 plus 80, 300 plus 80, 300 plus 80. These are all very good. These are correct. Minus 250. Now, can you see 250? They haven't shown here on the screen. But how did you get to is 60 plus 10? That's 70. 150. That's this 150. 30. That's 30. Then this is the correct answer. Like this, you should be able to, guys. I know it's how 300 plus 8 minus 250, but 250 they are asking how did you get 60 plus 10 is 70 plus 150 plus 30, option number 2. Right. Now let's go to the next question, guys. We're asking, identify which following is the good is not tangible. It's not a current asset. So therefore, guys, this has an answer equal non-current asset. Right. Then, guys, next part of the paper, task to complete the following numbers. I said you here like this, but you should up. Add and mark the answer. Mark like this one. You just have to guys do all these answers by one. Then guys, part see that we did here 100,000. That's the but non-controlling interest. So copy that here. Done. Because I'm waiting until the screen share loads. I'll just change my connection until that. Okay, right. So anyway, guys, screen share has come back. Okay, that part is also, guys, then done. So read mark the answer over here. Right. Okay. So guys, that is been explained to you all previously. Now, guys, can you remember? I said you something like this. I hope you remember. Fair value adjustment. Guys, I said you fair value adjustment first copy here, number one. Okay. So sorry, guys, I switched to hotspot. So I don't think we will be having any more interruptions going forward. Okay. My Wi-Fi is having a issue. Okay, right. So guys, like I was telling you all, I said you guys, when it comes to a fair value adjustment, step number one, we write it here. No, guys, we write it here. Why? Because it happened on this date. Then again, guys, we write it over here also. No. Why? Because we have to show this on the financial statement. We have to still show this. Right now, guys, think, see, I said you, when you write like this, what happens? Goodwill becomes credit. I said you that, no? When you write it over here and here, what happens, guys? Goodwill becomes credit. How? Guys, see, this 30,000 is inside this 250, no? This 250 went inside here, no? Can you see? I'm going to, guys, teach you how the goodwill becomes credit. How? Right, see, 30 is inside this. This 250 went here. Now 250, what's happening? Minus. Guys, see, goodwill is an asset. Asset is getting minus means what does it mean? Asset is reducing. Asset reducing means what side? Credit side. That's why goodwill becomes credit. Okay. So guys, once again, goodwill is inside this. This goes down as minus. That means when the goodwill becomes minus, guys, goodwill is reducing. Goodwill is reducing means it's becoming credit. That's why we say goodwill is credit and the PPE over here becomes debit. Now, guys, do you understand the double entry of the fair value adjustment? Copy it to both the places, but when you copy here and when it goes down, goodwill will become credit. Increase your PPE. So, guys, PPE will become debit. Simple as that. That's how we do the fair value adjustment. Okay. Right. So guys, that is one thing that I want to touch upon. If you don't understand, please ask me. Right. Another one thing, guys, what I wanted to explain to you all is URP. Now, guys, here I covered a situation where parent is selling to subsidiary. So guys, remember, study like this. If parent sell to subsidiary or if subsidiary sell to parent, this is always constant. Is that understood? Because guys, understand our objective is to remove the profit. So what are we selling here? Stock. No, that's why inventory is always credit. Okay. So whether parent is selling or subsidiary is selling, one thing that is always constant is inventory becomes minus, inventory becomes credit. That debit part is there, no guys, that only changes. Now here parent is selling to subsidiary means parent makes the profit. His profits are kept inside retained earnings, so retained earning becomes minus. Then guys, on the other hand, if the subsidiary sells to parent, what will happen? When guys think like this. If the subsidiary sells to parent, who is making the profit? Subsidiary. Okay. If the subsidiary sells to parent, subsidiary no guys making the profit, correct or wrong? If he makes a profit, he has to share between parent and NCI. Okay. Parent keeps his profits inside retained earnings. NCI keeps his profits inside the NCI working. So therefore, guys, from retained earnings, you have to subtract. Why we are subtracting? Because we want to remove the profit. That's why we are subtracting. From NCI also we are subtracting, but this is the catch. We are not subtracting the full thing. We are subtracting 80%. Here we are subtracting only 20%. Why? Parent owns only 80%, no guys. So that's why we are subtracting only 80% of the share. NCI owns 20%, no guys. So therefore we are subtracting 20%. Now if you're thinking 80% of what? 80% of the URP 5,000, 80% we are subtracting. 20% of what? 20% of the URP. So therefore, guys, the double entry will go like this. I'll show you and I'll go through it one more time if you want, like this. If subsidiary is selling to parents, then guys, what will happen? Inventory credit by 5,000. Just like this, inventory credit. Here also inventory credit. That no changing. That debit part is only changing. So guys, debit, it will happen like this. Okay. So guys, sorry about that one. Okay. Anyway, so over here, guys, inventory becomes credit. Retained earning working number 4, debit 4,000. By 4,000, 5,000's 80%. And then NCI working number 5, debit 1,000. How guys, 1,000? 5,000's 20%. This is how the double entry is passed when the subsidiary sells to parents. So guys, see the similarities. Here also inventory credit, here also inventory credit, the full thing. Here, retain earning debit. Why? If parent sell, parent makes the profit. He doesn't have to share with anyone. If he makes the profit, remove the entire thing from him itself. Okay. Here, in these areas, okay, if the subsidiary is selling to the parent, these are the areas where you have to adjust, right? Now, subsidiary is selling to parent, what? Stock. That's why from stock, we are removing 5,000. Now, ask yourself, if subsidiary sell to parent, subsidiary makes the profit, no? When subsidiary is making a profit, he gives a share to parent. That's why from parent, we remove the share, 80%. He gives a share to the NCI. That's why, guys, from the NCI working, we remove 20%. When subsidiary earns a profit, he has to give the profit to parent and the NCI, no? So parent's share of 80% will be removed from retained earnings. NCI share of 20%, guys, will be removed. So these are the places where you have to mark if the subsidiary sell to parent. That also you can do. Now you sent me another method. There, if you are doing that method, you will have to do it from working number 2. That's also correct. Okay. Yeah. Then what you should do is eliminate from subsidiaries retained earnings the whole 5,000 rupees. Then in that case, you will not be splitting like how I have done over here. That part you will not do. So I think how you studied is that you will go to this working and you will remove from this one 5,000 rupees. That's also okay. But the way that I do, I keep only fair value adjustment inside this. All the other adjustments, I do it outside. But what you're telling also correct. You can do like that also. You write URP, remove from this, finished. Then no need to split like this. Okay, so if the other students are wondering what is the other method that I'm talking about, you can also guys do it this way. Now see, on the other hand, rather than doing all of this, you can do like this also. This is also acceptable. If subsidiary sells to parent, who makes the profit? Subsidiary. Then guys, what you should do, you have to go here. Okay, then you will write here URP. Okay. And from subsidiaries, retained earnings here have no, guys. So from this answer, we have to subtract 5,000 rupees. That's another one way of doing things. Okay. Inventory will become credit. That's one. Subsidiary, no, guys, selling to parent. So subsidiary makes the profit. So subsidiary's profits are in the retained earning, no? So inside the retained earning over here, you have to subtract 5,000. That's another one way of doing. That's also correct. So you can choose whichever that is easier for you. Okay. Again, guys, if you didn't understand, see, subsidiary selling, no? So subsidiary makes profit. Subsidiaries profits are, no, guys, what we write here inside retained earnings. So we simply remove 5,000 from this. Done. Or if you don't like to do it here, then you have to pass, guys, like this 3 double entries this way. Okay. So that's another one way of, guys, doing things when it comes to URP. Okay. Then, guys, is there anything else? Don't worry, guys. I'll be giving the break to you all shortly. Okay, and one more thing, guys, over here in your exam, if the NCI value is not given, you can use this equation. Now, guys, in my paper, the NCI value was given, no, like this 80,000. If the NCI value is not given, you can, guys, use this method. Go like this, right? Number of shares in subsidiary into the NCI percentage into market value of subsidiary share. So guys, just in case in your exam, if the NCI value was not provided, then you can use this method. Number of shares in subsidiary, multiply with the NCI percentage, multiply with the market value of the subsidiary share, you will be able to find the fair value of NCI. Okay. So maybe guys, after the break, when I do the MCQs, we will be able to touch on this part. Right. Okay. Now, guys, the time is 7:25. We will have a quick 20-minute break. And after that one, guys, we will practice some more questions where we discuss more adjustments on consolidated SOFP. Right. Okay. So, guys, then can you have your 20-minute break and come back, guys, over there? Okay, right. So guys, then let's resume after the break. So we will be doing another one, part 2 question first from the consolidation area. After that one, guys, we'll practice some MCQs. So next week, we'll do income statement. Okay, now guys, look at this question that I have selected for you all. Right, it says, push and shove. Right, so again, we'll go with PNS. So now guys, they have given you, below are the summarized draft financial statements of PNS. Okay, now guys, can you see, they have given you an income statement. So this is an exam question where they are asking you to answer both sections of the income statement as well as the SOFP. So next week, I will do the income statement related adjustments. So today, guys, we'll focus on SOFP. Right, then guys, they have given you an SOFP. Then, okay, after that one, guys, they have given us some adjustments. Okay. So after the adjustments, guys, now these are the requirements that they want. Right, requirement number 1, state the accounting entries required to account the issue of share by push. Right, so guys, remember, normally we can buy a company in many methods, no guys, okay? Normally we can buy a company like this. We can either pay money and buy the company. That's what we call cash consideration. Then there is another one method of buying company called what, guys? Shares consideration. You give shares and buy the company. We call that a share exchange. So it looks like in this question, Push, who is the parent, has bought the subsidiary by paying cash. Sorry, by going for a share exchange. So let's learn how to account for that one separately. After that one, guys, they are asking calculate the goodwill. So guys, I have marked my goodwill working over here. Right, then what are they asking after that one? Right, state the formula for the consideration paid. Okay, so they are asking for this consideration. What is consideration, guys? Consideration is investment. How to calculate the investment? They are asking the formula. Then they are asking, state the formula which correctly calculates retained earnings of SHOV at the acquisition date. So they're asking you to calculate retained earnings at the acquisition date. That is also okay. Okay, and then guys, after that one, they have asked a theory question. Right, after that one, guys, they have asked what is the value of non-current assets. Okay, guys, by now you know how to calculate the value of non-current assets. No, guys, so normally, guys, how do we calculate non-current asset? Let me go to the next page. So non-current asset means, guys, how it will be? It will be like this. Parent plus subsidiary. Current assets, how to get the answer? Parent plus subsidiary. Current liability, how to get the answer? Parent plus subsidiary. Okay, that part is done. Okay, then guys, they are asking from you what is the value of the non-controlling interest. So that's why, guys, I have, made the equation here. Can you see? Non-controlling interest answer. And also, guys, they have asked the retained earnings answer. So therefore, I have set up my working over here. So like this, guys, what you should do in the real exam is also you have to go through, okay, the requirements and try to first understand what and what should we do. Keep them ready. Because if then you can do the question like normally, how do you do a part 2 question? Then that's easy for you. Okay, so therefore, guys, like how I always do, go through the requirements, understand what they're asking. Once you have understood that part, just start doing the question as if you're doing a part 2 question. Okay, right. Now, guys, we have understood the requirements. Okay, now, guys, let's then start answering the question. Okay. Okay, now guys, what happened here? First of all, guys, they have given an income statement for 30th of September 2008. So guys, remember, today our focus is not the income statement. That is for next Monday. Right, so income statement, just ignore, but just look at the date. It's 30th of September 2008. So keep that in mind. Okay, right, now guys, look at this part. On 1st of October 2007, Push acquired 60% of SHOV. Right, now guys, see, 1st October 2007. Our question is for 30th of September 2008. Good thing it's exactly 1 year before. Can you see? Our question is finishing on September 2008, no guys. So that means question is starting on 1st of October. When the question is starting, these people have bought the company. So this is a full year subsidiary. Understood? So therefore, guys, let me now update the group structure. Parent acquired 60% of S. That means there is a 40% NCI, and good thing that this is a full year subsidiary. Done. Finished. Good now, guys. Okay, let's go to the next part. Right. Of shove in a share exchange of 5 shares in push for 6 shares in shove. The issue of shares has not been recorded by push at the date of the acquisition. Push had a fair value of 6 each. Okay. Now guys, see, look at this part. Now how to work out this double entry, guys, over here. Okay. Now guys, look at this video. Now see, P is buying S. How is he buying S? He is going for a share exchange. Right. Now let's learn, guys, how to calculate it. Okay. Now guys, read carefully and see, will you? How is he buying? In exchange of 5 shares in push for 6. So he is going to give 5 shares in push for 6 shares in shove. So first of all, guys, we need to understand how many shares does the subsidiary have. So guys, here can you see equity share $1, 10,000 and 4,000. So guys, as you already know, this first part is there, no guys. This is whose one? This is the parent. This is the subsidiary. So subsidiary has 4,000 rupees. One share is $1. That means they have 4,000 shares in hand. Do you guys understand that part? These people have 4,000 shares in hand. Now, what's the ratio that these people are going for? They are going to go for 5 shares in push. So multiply by 5 for 6 shares in shove. So divide this by 6. For every 6 shares in the parent company. Oh, wait. Or is it the other way around? The issue of shares. No, wait. The capital in the share exchange of 5 for 6. Yeah, correct, guys. What I have done is correct. Okay, so they will be giving 5 shares for every 6. Right. Now, guys, can you then divide and see then how many shares they are giving then in exchange? So therefore, guys, 4,000, multiply this by 5, divide this. No, wait. I feel like I'm making a mistake. They're going to give 5 shares in push for 6 shares in shove. Okay, that part is okay. And then, guys, 1 share is 6 rupees. I forgot to take, guys, this into account. 1 share is 6. So then when I again multiply by 6, answer is, guys, coming back to 20,000 once again. Just give me a minute. On 1st of October 2007, Push acquired 60% of the equity shares. Yeah, okay, it makes sense because, guys, these people bought 60% of the company. No, that one I have not taken into account. Okay, so guys, once again, I'll go from first. It's like this. Now see, okay. The subsidiary company has, guys, yeah, exactly. That's the mistake what I have done. I haven't taken the 60% into consideration. Very good. Yeah. So, guys, subsidiary has 4,000 shares. From 4,000 shares, guys, we bought 60%. How did we buy the 60% of the company? We are promising to pay 5 shares for 6. So you will give 5 for every 6. So therefore, guys, when you do this part, answer will be 2,400. So 2,400 shares we have given in return. Now 1 share is 6. Okay, now guys, I want you to understand one thing carefully. When you go for a share exchange, there will always be 2 things called the nominal value and the premium value. There will always be, guys, 2 things that way. Now, guys, see, in our question, it says here $1. This is what we call nominal value. The market price is 6. So the difference between 6 and 1 is $5. $5 is what we call, guys, share premium. So you have to, guys, now calculate this one separately and show. Premium value separately, nominal value separately. So 2,400 shares, nominal value is $1, multiply by 1, 2,400. What will happen? Share capital will become credit. I'll explain one more time the whole thing, don't worry. And then again 2,400, the premium value is $5. So 2,400, guys, when you multiply by 5, then the answer, guys, will be 12,000. So 12,000 is premium now, guys. So share premium will become credit. Right now, guys, add both together, 14,400. What is this 14,400? That's the consideration. Consideration means investment. Investment account will become debit. This is how, guys, you have to account for the share issue. So, guys, once again, it's like this. See, guys, they bought 60% of the equity share capital. So the equity share capital of the subsidiary is $4,000. One share is $1. So that means 4,000 when you divide by 1, there are 4,000 shares. We bought 60%. How? In a ratio of 5:6 share exchange. Normally, guys, when there is a share exchange, please remember, you have to show nominal value separately, premium value separately. Nominal value is always this one, the minimum value. The excess when compared to the market value is the premium value. Get it done. Now learn the double entry. If you issue share, share capital credit. Any premium charge, premium will become credit. Add both together, investment account, guys, will become debit. This is how you account for a share exchange. Actually, guys, this is the answer what they are asking in the first part of the question. Here, guys, look at this one. State the accounting entries required for the share issue by push. Here, guys, now see what I have written. Share capital will become credit. So I'll go and mark this one over here. Issued share capital credit. How much? 2,400. So we'll write that. You will type this in the exam. Share premium credit by 12,000. So you will write this credit 12,000. Right. And then, guys, on the other hand, investment will become debit. Here, investment in shove 14,400 rupees and debit. This is how, guys, you answer the first part of the question. Right. Can you guys little bit check and see, are you clear with how I got the answer and how I wrote my double entries? Please check and let me know, guys, because normally in the exam, share exchanges are a little complicated. No, that only they will test because they know it's complicated. Okay, so therefore, guys, can a little bit check and see, guys, are you clear with what I have done over there? And also, guys, first check and see, guys, are you okay? I mean, writing this is not a problem. Okay, now, guys, I want you to learn one important thing here. Look at this part, guys. See, fun thing. Now, though this doesn't affect my question, what I'm doing, it's not going to affect, but I just want to show you this part. Look at this part, guys. See, the issue of shares has not been recorded by push. Parent didn't mark this answer yet. Can you guys see? The issue has not been recorded. So parent forgot to mark. So parent has issued shares, no, so he haven't marked this. So though this doesn't affect this, I want you to learn properly. If the parent gives shares, parent shares will increase by 2,400. Now, guys, parent forgot to mark this, no? So if I am to mark this, how it will work? Share capital credit means parent share will increase. Share premium credit, there is no share premium, so we have to create one. Share premium will become credit 12,200, 12,000 in the SOFP. And then investment debit. Investment is, guys, non-current asset. No, so I go to my non-current asset. Below this one, I will write investment and mark it here 14,400. So the parent has not marked this. So if we are to mark this, investment will be between non-current and current asset. Okay. Then, guys, on the other hand, share capital credit, add to your shares. share premium credit, it's not there. So therefore, I have to create a new one. This is how the share exchange is to be done. Right? Can you guys little bit check and see guys over there whether things are okay with you? Like, are you clear with what I have done so far before I move to the next part? Yes, no, right, okay. Now, guys, then let me move to the next adjustment of this paper. And also, guys, one more thing. Can you guys little bit tell me if possible, or maybe even answer to yourself, what should be the answer, guys, for this one? Okay, now see. Wait, guys, let me erase first of all the screen. There's so much things going on. Okay. Right, look at this part, guys. Now see, in your exam, now once you answer the double entry part, they are also asking you like this. Here, look at this part, guys. Fair value of consideration paid. What is that? Fair value of consideration paid means the value of the investment. So they are asking you value of the investment, item number one. Now we got 14,400. No, guys. Now they are asking you, help us select the correct option, right? Can you guys, you can either send in chat box or maybe you can, answer it to yourself, right? Can you guys select from these three what are going to be the correct answers? Like, how did we get 14,400? Which should be the correct option, guys, out of these three is what they are asking. Okay, so guys, then what should be the correct answer? It has to be, how did we get 14,000, guys? First, we got 2,000. It's like this, no? See, look at the options, 4,000 into 60%. So all are 4,000 into 60%. Okay, that's fine. That means 4,000 into 60%. After that one, guys, we did this one, no? 5 over 6. Here, 5 over 6. And then how did we get this answer? By multiplying by 1 and 5. 1 and 5 means 6. So therefore, guys, option number 3 should be the correct answer. See, 4,000 into 60% into 5 over 6. And here, guys, to get this, you multiply twice, no? One by one, other one by 5. So, guys, over there, both when you add together, guys, $6, no? So, therefore, guys, that's how we got the answer, right? Option number 3. Okay, right. Then, guys, let's move to the next part then of the question. Let's go to this part. Yes. Yes, Adil, tell me. Uh, isn't it? Wait, let me check one more time. 2,400 into 6. Okay, no, I think it will be okay because see, right, 4,000 into 60%, that multiplied by 5 divided by 6. Beta, 4,000 into 60%, then that's 2,400, no? That you multiply by 5, that divided by 6 is 2,000. Okay, okay, yeah, I get what you're saying. Wait, then did I make a mistake on my calculation over here? Then the answer is exactly coming to 12,000. No, yeah. What you're saying is correct. Hmm. 4,000 into 60%. No, guys. Guys, over here I had made a slight error. Over here, guys, I have made a small mistake. That's where everything went wrong. So sorry, guys. It's my mistake. I had done a big mistake here. Here, guys, I had done a wrong thing. Here, guys, see, 4,000 into 60% is 2,400. No, guys. So 2,400 multiplied by 5 and divide by 6. Here, the answer has to be 2,000 shares, guys. Okay. Here, I had made a big mistake. See, guys, 4,000 into 60%, that into 5 and divide by 6. Here, the answer is 2,000. So that means, guys, here when the answer becomes 2,000, 2,000 into 1 is 2,000. 2,000 into 5, answer will become 10,000. That means, guys, over here, the answer has to be 12,000. Then when you do this part correctly, you should be, guys, able to get the answer. Okay. Then when you do this part correctly, I mean, I explained it properly, but when I did here, I had done a small calculation error. This one, when you do, answer is 2,000. So 2,000 into 1, 2,000, 2,000 into 5, 10,000, then 12,000. So then, guys, you will be able to get the answer. Option number 3 should be, guys, the correct one, which is 12,000. That's the correct answer, guys. Okay, not 14,400, guys. Please correct the error. It has to be, guys, 12,000, which is option number 3. Right. Okay, no, right. So, guys, then with that part, we're done with this one. Okay, now, guys, then let's move on to the other adjustments that we have on the paper. Okay, let's see. Right. Okay, so guys, from the first adjustment, then I have marked all my entries. Okay, then so I'll write, guys, over here investment. How much was the investment that we got? 12,000. No, 12,000 was the investment that we got. Okay, now, guys, next one. At the date of acquisition, the fair value of S is equal to their carrying amount. What does this mean? That means there aren't any fair value adjustments. Okay. At the date of acquisition, fair value of S were approximately equal to their carrying amount, meaning there aren't any fair value adjustments. Right. Then, guys, let's go to the next part. Okay. Now, guys, look at this one. Right. Something new. Push has a policy of accounting non-controlling interest at fair value. The fair value of $1 share in S is going at 3.5. Consolidated goodwill is not impaired. Anyway, guys, remember, for the FA level, impairment is not there. Impairment of goodwill or goodwill reducing, we study it in the next level, which is FR, not here. Okay, anyway. Now, guys, there is a difference. In the earlier question, they gave you the value of NCI. In this question, they are not giving. So when they don't give you the value of NCI, what should you do? You have to calculate it like this. Now, guys, look at this one. NCI percentage. In our question, how much is the NCI percentage? 40% NCI. So I take 40%. Multiply by number of shares in S. Guys, in the S company, how many shares were there? Here, guys, can you see? In the S company, 4,000 divided by 1. That means there are 4,000 shares in the company. Multiply this by market value of SR share. Here, guys, can you see? The SR share market value is 3.5. So like this, you have to calculate and take what you can say, guys, the value of NCI. So when the value of NCI is not there, this is how you calculate. Take the NCI percentage, See how many shares are there in the subsidiary company. That one, guys, you multiply by the market value of the subsidiary share, not the parent share. Don't multiply by 6. NCI is not inside the parent company, no, guys. NCI is inside the subsidiary company. So you have to calculate, guys, using this. Okay, now, guys, can you multiply and see what will be the answer then? Right, 4,000 into 40%, that into 3.5. So therefore, guys, the answer is coming as 5,600. This is going to be the answer. And now, guys, don't forget what's the double entry, guys, for the fair value of NCI. Double entry is what? You write it here, then goodwill will become debit, and then NCI should become credit. Like this, you have to mark it and show. Learn the double entry always. When you write it, always, guys, in your mind also, you repeat the double entry. That's how you're going to learn consolidation, guys, properly. Guys, remember consolidation, you have it in all 3 levels. Knowledge, skills, professional. Even at the SBR, you will have this. So this foundation is the key, right? So remember, guys, when you write it here, goodwill debit, and when you write it here, NCI becomes credit. Right, that part is also done. Okay. Right. Guys, now on your own, if possible, can you guys start calculating, guys, this part for me? Can you try to do the URP on your own? Now here, guys, they have given you a URP adjustment. Can you guys first calculate the URP if possible for me, guys, first? And also this adjustment, on your mind, can you work it? What should you do? Actually, guys, this one and this one, both were there in our last question also. So what I want you to do is like this. You go through this one and this one. This one, I want you to calculate the URP. I'm not asking you to write double entry. Just calculate and keep it. This one, in your mind, can you guys make up the adjustment? Like what and what should you do? Whether you have to add those, subtract or whatever. Can you guys check on that part now? Right? Roman number 4 and guys, Roman number 5. Okay, just try to do that part because I'll give you a few minutes. Okay, right. So guys, essentially work out that one. Okay, so look at that part, guys, then. So it says sales by S to P. Now, guys, look at this question. Now, in the earlier question, what happened? Parent sold to subsidiary. Here it's the other way. Subsidiary is selling to parent. So, guys, subsidiary to parent were 6 million. They made a markup of 20% on these sales. 1/4 is remaining inside the inventory. Okay, so guys, see, first of all, to get the URP, this is the formula. Profit into inventory held. Now, guys, what is the percentage of inventory held? 1/4 remained in the inventory. So that I'll mark it, guys, over here. Inventory held is 1/4. Now, what you need to do now, guys, you have to calculate what? The profit. How to calculate the profit, guys? Use this equation. Now, this is what, guys? Markup. So, guys, understand, if it is markup, cost is 100%, profit is 20%. Now, guys, earlier it was margin. Margin means sales is 100%. If it's markup, cost is 100%, profit is 20%. That means selling price is going to be 120%. Are you guys agreeing with that part, guys, over here? Are you okay with this part? Once again, guys, see, if it's markup, cost is always 100%. Is that clear? Cost is 100%. Then our profit is 20%. Okay, profit is 20% that they are telling. So, guys, then something minus 100 is 20 means this has to be more, no, guys? So, this 120%. Okay, now, guys, what you do? They have given sales is 6 million, then that's selling price. Selling price is indicated by 120%, no, guys? So, therefore, divide this by 120 and multiply this by how much? 20. Why are we multiplying by 20? Because you need profit. Because you need the profit, you are multiplying this, guys, by 20 over there. And now, guys, check and see what's going to be the answer. Right? So, therefore, guys, answer will be 6,000 divided by 120 into 20. So, therefore, guys, answer will be 1 million. Take the 1 million and, guys, put it over here. Multiply by 1 over 4. The URP will be 250. Right. First of all, guys, can you little bit check and see, are you clear with the URP calculation, guys, first? Little bit check and see. Are you okay with the URP calculation? Like how I got the answer? Okay, so guys, once you get the URP answer, what's the double entry, guys? Now, remember, doesn't matter who sold to whom. Parent can sell to subsidiary or subsidiary can sell to parent, doesn't matter. Always inventory will become credit by 250. Inventory credit means, guys, inventory minus. Now there is a difference. Now in our question, who sold? Parent, sorry, subsidiary, no, guys, sold to this one. So you think of it like this. If subsidiary sell to parent, subsidiary makes the profit. Clear? Subsidiary has to always share his profit, no? Share among whom? Among the parent and the NCI. Guys, listen. Subsidiary is owned by these two people, no? So if he makes a profit, he has to share. If he makes a loss, he has to share. So because he is making the profit, he has to give some profit to parent and some profit to NCI. So from parents one you remove, NCI also you remove. Parent keeps his profit inside retained earnings, so remove from there. NCI keeps his profit inside NCI, so remove it from there, but not the whole thing according to the ownership percentages. What does that mean? Take 250. Now think, parent will get how much percent of this one? 60%, because he owns 60% now, guys. So see 60% of this one. NCI will get the remaining. Remaining means how much, guys? The remaining 40%, he will get it over there. Right, check and see, guys, then what will be the answers in that case. So therefore, guys, 250 into 60%. Answer is 150 minus and NCI, guys, over here. Answer will become 100. Okay, so this is how, guys, the URP entries are supposed to be passed. Okay, right. Can you guys just check and see, are you comfortable with the double entry that I did over there? Just to see, guys, whether you understood this one completely. Okay, no, right. So guys, because you all are not asking any doubts, I assume everything is okay. But if you have a difficulty, just ask me. Right now, guys, let me now do these entries. Inventory credit. Inventory is current asset. No, guys. So current asset, I'll go and mark there minus 250. Retained earnings debit. So guys, remember retained earning debit means minus. So I'm going to my retained earning working and minus 150 from that. And then in my answer sheet, what was there? NCI debit. NCI means this working. I go to this working and I write here, guys, minus 100. This is how the answer is done for the URP accounting entries. Right. Then, guys, on top of that one, I also said you, if possible, try to answer this part. On 30th of September, S had a receivable of 1 million. Guys, one person receivable means other person payable. What do we call these transactions? We call these as, guys, current account transaction. Normally, guys, current account, how do we do? For one person receivable, no, go and remove minus 1 million trade receivable credit. For other person payable, no, payable is current liability, no, guys. So payable minus 1 million. Simple as this, guys. This is all what you should do. Okay. Remove from current assets, remove from current liability. That's it. I think we are done with all 5 adjustments of the paper. Yeah, all the adjustments are complete. Okay, right. So guys, now in that case, now we can now start answering the remaining parts of the question, and then guys, we can fill all the numbers over there. Okay, now guys, now that we have done, okay, now working number 1, guys, is complete, all done with it. Right now, guys, let's do then quickly working number 2. Okay, so guys, once again, working number 2 is, guys, what? Look at the words carefully. Net asset of whom subsidiary. Think of it this way. Net asset means what, guys? Net asset means equity. Equity of whom? Subsidiary. So subsidiary is this person. Okay, now guys, look at this one. The equity has 2 parts. So what are the 2 parts? One is equity shares. The other one is, guys, retained earnings. Right. Now subsidiary, guys, now normally, guys, these 2 are what date? Acquisition date or reporting date? Always these 2 are reporting date, the day that we are doing the question. So copy this one. 4,000 and 16,500. Okay, now guys, listen. Normally, guys, when it comes to the equity share, right? Over here, guys, this one, will it change? Okay, this one, guys, will it ever change? No, guys, this one will never ever change. So therefore, the same answer, we should put it over here. Normally, guys, what I have noticed is in FA and in FR, usually, guys, the equity share of the subsidiary will never change. Right? So therefore, guys, just mark the same answer over there and keep. Right. Retained earnings. Now, guys, retained earnings is where you have to adjust it. Okay, retained earnings is where you have to see, because normally, guys, retained earnings, usually they will give it in the adjustment. Right. Now, guys, in this paper, can you see? Right. Roman number 1, 2, 3, 4, and 5. In all these, did we ever get the retained earning at the acquisition date? No, guys, not really, no. Now, in the earlier paper, in Roman number 1 itself, they gave, this is the retained earnings at the acquisition date. They gave it. But in here, I do not see that part. The retained earnings at the acquisition date is not given. Then in that case, guys, what we should do, we should find out this one. Right. Normally, guys, this is the equation that we use. Okay, look at this part, guys, over here. Let me zoom it in. Right. Here, guys, I have given the note also. Look at this one. Right. In the question, retained earnings at the acquisition date is not provided. Just as we saw here, that value is not given. So since that value is not given, we need to work it out this way. Right. Now, guys, we are looking at whose retained earnings? subsidiaries retained earnings. Here guys, look at this. Subsidiaries retained earnings I have, but that's at the end. 30th of September 2008, reporting date. So let me mark this over here. Right. Now I need what? The retained earnings at the acquisition date. Here guys, look at this one on 1st of October. Luckily, 1st of October 2007 is when we bought the company, which also happens to be the start of the financial year. Do you understand that part here, guys? See, now, why are we struggling so much? Okay, why are we doing this? Because, guys, on 1st of October 2007, no, we bought the company, acquisition date. On that date, retained earning, they haven't given. So how can I derive that answer? It's like this, guys. See, the retained earnings at the acquisition date is the same date as the beginning of the financial year. So in simple words, I need retained earnings brought forward. So how to get the retained earning brought forward? You can use this equation. Get your retained earning carried down, which is this, and deduct the profit for the year. Profit for the year, guys, I can find it on my previous page, which is my income statement. Here, can you see? Shav is a subsidiary. His profit for the year is 4,100. So when I remove 4,100, I will get the retained earning at the start, which also happens to be the retained earnings at the acquisition date, because that's at the beginning of the financial year, no, guys. So this is how we get the retained earnings in this question. So please remember, guys, if the retained earnings at the acquisition date is not given, this is the equation that we use in order to find it. So normally in the paper, retained earning carried down will always be given. That is only this one, the retained earning of the subsidiary at the reporting date. We bought the company at the start of the year. So from my retained earnings, I have to remove profit. So when I remove the profit, I will understand, guys, what's my retained earning brought forward. So that's my retained earning brought forward, guys, which is going to be 12,400. So what we do now, guys, we should now take this answer and write it here as 12,400. Done. Okay. Then, guys, in my paper, unlike the last question, I don't have fair value adjustments. Fair value adjustments are not there. So therefore, now, guys, we can close this. 4,000, 4,000, nothing. Here, guys, answer is 4,100, the difference. Okay, now add these two, 16,400, 20,500, and over here, 4,100 once again. Okay. So add it this way. Now start subtracting and mark the difference. Right. Now, guys, see this 16,400, we should take it here. Goodwill. See, net assets at acquisition date, working number 2. Go to working number 2. This is the answer. Copy it here, 16,400. This answer, guys, what we have over here. Post acquisition, this one. So this one we have to always split between parent and NCI. Got it? This answer we have to always split. Now post acquisition means what we have earned extra. Subsidiary, when earning extra, should divide their answer among the owners. So who are the owners? One owner is parent, then give to parent. Other owner is NCI, give that to NCI. Okay. One owner is parent, other owner is NCI. So you split and give the answer. So, guys, parent, where do you give? Think. 4,100 came from whom? Retained earning. So then give it to retained earning, guys. So you go here, post acquisition reserve, 4,100 into 60%. Balance answer goes to whom? NCI. So you go to your NCI working, here post acquisition reserve, right there, 4,100 into 40%. Done. Okay. Now, guys, when we get these answers, how much it will be? 4,100 into 60%, which is 2,460. And over here, guys, the answer will then be 1,640. And then, guys, one more thing. Okay, now let's calculate. 12,000 plus 5,600, guys, 17,600. 17,600 minus this 1,200 is the goodwill. Is that correct? Yeah. Okay, this one, guys, over here, retained earning brought forward of parent. I forgot to take that from my question, so I'll mark that one, guys, from here. See, right. Brought, now see, retained earning. So go to retained earning. This one. Yeah. Brought forward of the parent. So, guys, parent is this 35,400. Okay. So that we'll write it here. That's it, guys. That's pretty much it. Okay. Right. Then, guys, we should total this and get the answer. You should total this and also get the answer. And then, guys, on the other hand, they also want non-current assets. Now, normally, guys, how do we get non-current assets? Non-current assets like this, no? Go to non-current assets. There are only two. Sorry, there is only one. Parent plus subsidiary. That's how, now, guys, we normally do asset. Okay, so let's start that one. 40,600 plus 22,600. Current assets. Okay, normally, guys, how do we do current assets? We take parent at which subsidiary. Okay, so that means, guys, over here, plus 16,000 plus 6,600. Current liability. Normally, guys, how do we do current liability? Parent plus subsidiary. So therefore, guys, over here, 8,200 plus 4,700. This is how, guys, we should get the answer. Okay, now, guys, we have actually done all the workings. Shall we, guys, select the answers now from the options? Okay, let's check and see, guys, whether we are able to get those. Now, this one, guys, we already answered, no? Okay. This one also, guys, we answered, no? Item number 1. How did we get item number 1? That is this one. We selected this as the option. 4,060% into 5/6 multiplied by 6. Okay, now, guys, look at this question over here, will you? Right, second question, they are asking item number 2. Okay, item number 2. Select the formula which correctly calculates retained earnings at the acquisition date. Okay, now, guys, can you remember in our paper, retained earning at the acquisition date was not provided. Did you see that one, guys? In our question, retained earnings at the acquisition date was not provided, no? So because it's not provided, we calculated. So they are asking, how did you get this answer? 12,400. Show the working. Okay, now, guys, can you quickly go through this and, guys, select the working on how we got the answer? That's easy, no, guys. Nothing difficult, no. From 16,500, we reduced 4,100. Here, 16,500 minus 4,100, we got 12,400. Can you see? So that's how they're asking the answer. Okay, let's go down, guys, to the next part. Okay. Guys, now they are asking, select which of the following calculates goodwill. See, they are not asking the goodwill answer. They are asking the formula. Can you guys see that? Here, they are not asking the value. They are asking you, tell the formula, how you calculated goodwill. Here, guys, now can you look at this formula and quickly decide what should be the correct answer in that one? Okay, so, guys, what should be the correct answer? It has to be, guys, option number 3, no, if I'm not wrong. Right? Here, guys, look at this one, will you? Fair value of consideration, fair value of consideration, fair value of consideration. Fair value of consideration means what, guys? Fair value of consideration means this one, investment, plus the value of NCI here, plus fair value of NCI, Here minus, so this is wrong, plus fair value of non-controlling interest. Then we subtract the net assets at the acquisition date. Now here they're telling plus, that's why this is wrong. Minus the fair value of net assets at acquisition date. So therefore this has to be the answer. Okay, now guys, let's go to task number 2. Now guys, in task number 2, can you guys see they're asking the value of non-current assets. So therefore what you have to do, like this guys, simply here, this part. So when they ask you non-current assets, add these two, show the answer. Current assets, do this working, show the answer. Current liability, you do this working and show the answer. Simple as that. Right, now guys, on your own, can you guys help me select the answers for this one? Non-controlling interest. Now guys, here on the screen, you can see the working, no? Okay. They are asking, how did you get these numbers? Non-controlling interest, they don't want the final answer. They are asking you, how did you get these? Show the working. Even the retained earnings, they are asking you, show the working. How did you get the answer? Right now, guys, can you look at these numbers and select the proper option, guys, quickly on how you got the correct answer? Okay. Task number 3, guys, A and B. You look at the working, what we have done here, and then select the correct Roman number quickly, if possible. I'll give you 2 minutes time. Okay, right. So guys, were you all able to find the answers? Okay, shall we discuss quickly? Right, first one. Guys, how did we get this now? First, they're asking non-controlling interest. No, okay, 5,600. How did we get, guys? Like this here. 40% of 4,000 into 3.5. Here, guys, 4,000's 40% into 3.5. That means, guys, this is the only option that's available. See, if you get one part, okay, then the answer comes automatically. See, guys, how did you get 5,600 once again? 40% of 4,000, that into 3.5. This also okay, no guys, see 4,100 into 40%. There you go. Minus, okay. So if you're seeing, guys, how did this 250 came like this, guys? Now 250 is the URP, no? That one's 40% is 100, no? That's how no we got this answer. Can you remember? 250 is URP. That one's 40% only what comes here, 100. So they are showing like that. 40% of 250. That's the 100. So that's the answer. Right. This one, guys, here, see 35,400. So that's this. This has to be the correct answer, actually. And then add 2,460. That is this. And then, guys, 150 is this. 150, I'm connecting it to 250 because 250, 60% only, guys, is 150. That's how now we got the answer. Okay, so that's why, guys, I have selected that over there, right? So this is how, guys, you answer this particular question in the exam kit for consolidated SOFP. Right? Can you guys check and see in these two questions? Do you have, guys, any doubts? Okay, right. So not doubts at all. Okay, right. So guys, I'll share then all of these with you all, right? So let's do a quick set of MCQs, and then, guys, what we'll do is we'll then conclude the class after that one. Right. Even, guys, these MCQs also, what I'm doing, I'll share it with you in the group. Okay. Right. So guys, I'll give you all some easy MCQs because you all have done a lot of work today. Okay. Guys, can you try to do for me these two MCQs, guys, over here? This question and this question. So I have given you two easy questions only, right? Can you guys just try to do this one for me? This one and this one. Okay. Please try that one, guys, for me. Okay, right. So guys, shall we discuss this question, an easy one? So what does it say, guys, over here? They are telling Dora's statement of financial position includes a receivable due from Diego. So guys, this should not take you that long, right? 40,000 receivable from Diego means, guys, how it will work like this, no? For one person, receivable means we go and subtract. Just subtract this. Doesn't matter from whom. Okay. For one person, receivable means other person payable. Then you go to payable and reduce 40 from that also. Okay, now, guys, how to get this answer? Payable. Normally, guys, how do you do payable? Take the parent, add the subsidiary, and subtract. 320 plus 180. What's the answer, guys? 500. 500 minus 40, 460. Then this has to be the correct answer. Okay, A. Right. Then, guys, receivable, how do we get the answer like this? No. Normally, receivable is asset. Parent plus subsidiary. 540 plus 160 will give you 700 minus 40, 660. There you go, guys. That's how you get the answer. Easy question. Right, try this one, guys, over there. What is this question? This is only going to be URP. Okay, right. Now, guys, normally, guys, how do we do URP like this? Now, guys, normally URP, the equation is profit multiplied by inventory held. Okay, right. Okay, now, guys, first let's find the inventory held. Salt owns 70% of pepper. 40% of the goods were sold. Okay, now, guys, think. If 40% was sold, that means, guys, now how much is remaining? Okay, if 40% was sold means held is 60%. Okay, that means, guys, over here 60% is remaining. Are you guys okay with that part? 60% is remaining. So if 60% is remaining, now calculate the profit. Okay, normally, guys, this is how we do profit. Profit is equal to selling price minus cost. Right, now these people are, guys, using a markup. No, markup means profit is 20%, cost is always 100%. That means selling price, guys, has to be, if this is 100 and this is 20, means it has to be 120%. Okay, now, guys, let's work it out. 1044 is selling goods. So 1044 is selling price. So that means, guys, 100 and 1044 is represented by 120%. Divide by 120. We want profit now, guys, so multiply by 20. So therefore, guys, when you multiply by 20, 1044 divided by 120, that into 20, guys, answer is 174. Now, guys, what you do, you take 174, put it, guys, over here, that into 60%. Right, now, guys, let's check the answer and see. Then 174 into 60%, guys, answer is going to be 104.4. So, guys, 104.4 means this is going to be the correct answer. Right, check and let me know, guys, for any doubts that you have, guys, on this question. Okay, right. So, guys, if that's okay with you all, guys, with that, then we can then conclude today's class. I will, guys, share all the materials with you all what I have been using. So, guys, then next week we are going to revise on consolidated income statement. Okay, plus some more MCQs, guys, on consolidation. Definitely we have to do. But anyway, guys, next week target area is, guys, consolidated income statement. Okay. Amanat, 1 minute. Let me little bit check on these. I think the recordings of this should be available to you, but I'm not really sure from where. So what I'll do is I'll quickly check with the admin and I'll share a message on the group when I'm sharing the tute as well. Okay. And on the other hand, they I think streaming this in YouTube. So I think this should be available in YouTube in their channel as well, if I'm not wrong. Okay, right. So guys, then with that part, then we'll conclude then today's class, guys. Then take care and stay safe. I'll see you all then next Monday at the same time. I'll guys share all the materials, whatever that I have used. Okay.